Matt Lloyd and Western River Anglers, and I'm going to go out there and look for sturgeon. It's going to be great.
Cool.
We'll do that.
Looking forward to that.
Joining us right now on China, the definitive conversation of the day, William Lee joins us with all of his work at the International Monetary Fund, chief economist at Milken Institute. Anybody that watches surveillance knows he is beyond prescient. I want you to peel back the curtain, Dr. Lee, right now, particularly on the three cities. What's the level of sweat? What's the level of panic in Beijing?
It is huge, John. And Tom, and when you were asking who's the policymaker in China, when you talk about state capitalism, there's only one policymaker, that's Xi Jinping. And when you have one policymaker who's interested in not only preserving the economy, but also preserving his own position and consolidating power, there's only one set of solutions, which is you gotta get the private sector under control. And that, unfortunately, is their Achilles heel, because right now, to restore the Chinese economy, to get youth unemployment down, to get growth going again, you need the private sector. But who in the private sector is going to trust the policies of the CCP?
What is the importance of the dry up of investment from America, investment from the Western world? Within all the great work I've seen, Dr. Lee, the number one thing I'm focused on is we've lost our trust with investment in China. How important is that?
Oh, that is absolutely critical. The discussion at most of the meetings here at Milken among our sponsors, who are some of the biggest investors in the world, they all asking, how do we do due diligence in China when the information is controlled by the policymaker, Xi Jinping? Private sources of information that they normally relied on to do due diligence, even on the company level, are now restricted. So when you restrict information flow and when you direct common prosperity themes that essentially say to people, you can be successful but not too successful, and certainly not too powerful, those are the kind of vulnerabilities and risks that Western investors are now facing. And they're asking the question, do we really need to go to China? Are there other places to go?
Which raises a question. Is Xi Jinping and his party not stimulating the economy as much as people expected because they don't want to, or because they can't?
Well, Lisa, as you know, I've come on so many times talking about the fiscal policy tools they have. The fiscal space they have, the degree to which they can increase fiscal spending depends on a lot of the health of the local governments. And local governments are now so indebted, they can't sell more land to finance more infrastructure spending, which has been their main fiscal tool. And so right now, I think they're pretty constrained. And when the renminbi is dropping like a rock, it's very hard for the central bank to be dropping interest rates. And so we have these 5, 10 basis point moves that, I mean, this is truly a situation where monetary policy is pushing on a string. When everyone has lost confidence that the private sector can be survivable, we are asking them to go borrow money at even 5 or 10 basis points. That's not going to make any difference at all.
When I talk with different investors, some of them say maybe this is actually a positive thing for the rest of the economy globally, because this will import disinflation to the rest of the world. Do you buy this argument?
I think it's positive for the rest of the economy because Xi Jinping's plan is to make China into a domestic economy and high value-added production. That means low value-added production is moving out to the rest of Asia and other locations. And that's where I think the capital flows are helping the rest of the world. But in terms of the Chinese economy, it's going to be a real hat trick to be able to revive the private sector, redirect innovation in the direction of these high-tech and high value-added industries, and to pull it off successfully right now with such low credibility.
So what is the to-do list for Beijing? Do they use the formulas that have been proven beyond Mao? Do they, as the consensus is, stay with Mao formulas that didn't work? What's their math here on a day-to-day basis? What do you expect to see, Dr. Lee?
They need to make structural policy into counter-cyclical policy. For example, if they put in a social safety net, that would immediately cut out the need for private sector.
Bill, I'm going to interrupt you there. We've looked for a social safety net since you and I were in our ute. You were back at the IMF running into me in a hallway. There's no social safety net. There's no dominant consumer. It's the same old for Beijing. Do they stay with that script, or can they actually do something?
If they don't change the script, then you're going to have these rising inequalities generates social unrest, and that's the last thing they are able to tolerate. So yes, you and I have talked about social safety. When I was mission chief at Singapore, I suggested social safety net for Singapore, and then 2 years later, they actually put one in. So maybe if we talk about it long enough, and they'll realize that it's either social safety net and allow people to feel safe and they don't need to save as much for themselves, which means they consume more, or you get social unrest. And if those are the trade-offs, I think Xi Jinping will go towards safety nets.
This is why that youth unemployment number is just so important at the moment. Bill, thank you, sir. Bill Lee there of the Milken Institute. If we played the game at the start of the year, what would be up more? The Hang Seng or the S&P 500? How many people would have said Hang Seng down 11% year to date, S&P 500 up 14? Tom, 25 points of outperformance on the S&P 500.
Yeah, that's the way to look at it.
What happened to China
the differential
reopening?
Well, the China reopening has failed, and again, this is where the currency comes in. On radio, we're showing it right now on TV, 7.31 yuan per dollar. No one thought we would get to that, and I'm going to use this word carefully, devaluation. This is not a free float, in my opinion, and Dr. Rogoff can tell me I'm wrong, but the answer is this is a devaluation of the currency, and the number one sweat or panic I see is that's log convex right now, and that accelerates out 7.40. I'll let an adult tell me, but the answer is that's a single statistic to watch.
The twin surprise of 2023 so far.
Yeah.
The underperformance, the downside surprise we've seen from China, and the outperformance, the upside surprises we've seen from the United States going into Jackson Hole later this week.
And to take it even further to NVIDIA later this week, it's the 7, 8, 10 stocks here, the technological superiority of the U.S. right now versus what you see in China.
Average price target on the S&P coming into the new year was just north of 4,000. Hey, look, their year-end price targets, we've still got some work to do this year, but that was the year-end price target at the start of the year, just a little north of 4K. And then on watch for record highs at one point in July. Do you remember a couple of weeks ago, it was all soft landing hopes and dreams, and then a bond market sell-off later, and it's all hard landings, Fed's got to do more. It's amazing what price can do. Yields right now higher in the bond market, much more on fixed income in the next hour. Amanda Lineup of BlackRock, 7:30 Eastern Time. That conversation about 50 minutes away. Equities positive here by 0.4%. Yields are up, treasuries are down from New York. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
On the next episode of The Circuit. It's still almost shocking how new you still are to this sort of being famous thing.
When I do, go out and people are like crying, that's when sometimes I'm, whoa, why? There's no rule book for it.
Watch The Circuit with Emily Chang, Thursdays, 10 p.m. Eastern on Bloomberg Television, or 8 p.m. Eastern on Bloomberg.com or the Bloomberg app on connected TVs.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
continue to see that movement higher in yields, then of course you have to look at tech stocks that traded up to their 2021 peak just a couple of weeks ago. And that's why they're underperforming. They're underperforming not because they all of a sudden became worse companies. They're underperforming because they went up a lot, got very expensive, and now in that context of higher yields, you can't really justify that expensiveness.
That was Cameron Dawson, a new edge going into the weekend after a bond market sell-off has dominated the airwaves for global financial media. Continues this morning too. Let's talk about that. Equities right now positive on the S&P 500 by around about 0.5%. The move continues in the bond market, or should I say resumes. Yields are higher by 4 basis points on a 10-year, 4.30 on a 10-year in America. Think about the levels last October. 4.30-ish was the high for the cycle. We're at those levels again in the bond market. So 10-year on a closing basis, the highest levels we've seen since 07. We're talking about decade highs at the long end on a 30-year right now. Yields up to 4.43. This was the stuff of dreams in the depths of the pandemic when all you could pick up was something like 60-ish basis points on a 30-year, Tom. And now you can get 4.30. Do you want some of that?
Yeah, but the way I'm going to look at it, John, is I'm going to go from the nominal yield, which I totally agree is what we're living in, but I'm going to go to the investable real yield, and all of a sudden there's some substantial real yields where you go, wait, how does this work? For example, pick a number, 7% mortgage rate, whatever your belief is the inflation rate is. Let's say it's 5%. That's a 2% hole every year. You've got to pay out a 7% mortgage within a 5% inflation. I mean, the math doesn't work.
March 9th, ugly times, 0.6987% was the low in the pandemic on a 30-year yield, Lisa. South of 70 basis points. Nobody that came on with us at that point was looking out 2-3 years and suggesting we'd be anywhere near where we are right now.
And maybe it's just the people who I speak to, but the people who did suggest that rates could go substantially higher were calling for, some sort of financial meltdown in response because everything had been hinged off this ultra low rate. So this would cause absolute havoc across the financial system. And here we are, stocks grinding higher and higher, and people basically looking at that soft landing and gaming out that the Fed's going to win this.
Is the Fed going to win this? Is that what they're gaming out based on this?
Actually, what we're seeing, no, they're not going to win the war on inflation, but they will win the war on achieving some sort of stabilization to a new high that doesn't destroy the rest of the economy and lets everything else chug along without the unemployment rate rising. There was a recent poll done by NBER that basically confirmed that now 70% of respondents thought that the Fed would achieve a soft landing. 70%. That's turning on its head what it thought just a year ago.
Hopes and dreams, Tom. Hopes and dreams.
But the hopes and dreams of Jackson Hole are to August 31 PCE number and September 13th CPI number. Maybe that will be in his speech. We just got to wait to see what those two dates are.
Yeah, which is why dancing around what they will and won't do in late September when you've got more information still to come. How much value is there in that?
No, I think like Mohamed El-Arian, is he on with us today? I don't even know what the schedule is.
Should be with us later this week.
The intern's left, so I'm lost. What can I say? But the answer is Dr. El-Arian is going to be with us later this week, and his essay in the FT is important. And what's not in there is data dependency. That's the excuse Chairman Powell has.
We are data dependent.
Yeah, we're also intern dependent. Look where that got us. Right now, joining us, and we're going to get a brief here on 57 things in tech. But what I really want to do is once and for all dive into what this thing, NVIDIA, is. Mandeep Singh is going to make your morning, senior tech analyst for Bloomberg Intelligence. We really haven't done this exercise. NVIDIA RTX trademark and NVIDIA Omniverse trademark deliver the performance to help professionals, creators, developers, and students worldwide enhance creative workflows and build, operate, and connect metaverse applications. Butch Cassidy and the Sundance Kid. Who are these guys? Who is NVIDIA?
Well, they have a history of almost 25 years in the graphics domain where they made the chips that enabled all the games, and gradually they branched out into first crypto and now generative AI. And what they've been really good at is catching the new trend early on. This space isn't new. AMD has been around, Intel has been around, but what NVIDIA has shown time and again is they can catch a new trend early on, and they can actually have performing chips in that space, and that's what they've done with generative AI.
When they report here this week, are they going to sustain the financial analysis screen I see on the Bloomberg? They're popping 70% gross margin to bringing down 40% net income margin. Come on, this is like a cartel.
It is, and even before generative AI, they had those kind of operating margins. And what's really unique about NVIDIA is they've got the pricing power. No one else in this space has been able to show that kind of pricing power that NVIDIA has shown. So that just goes to show they've got some real IP when it comes to training these large language models, which is why, hyperscalers, even though they are developing their own chips, they're willing to pay NVIDIA the dollars when it comes to getting the inventory for their chips.
Which is the reason why people are trained on Wednesday, and the fact that NVIDIA is going to report earnings. And perhaps more interesting to me is less the earnings and more the market's response. Does the market need to see the dollars coming in the door to justify the hopes and dreams that have been baked into the share valuation?
Absolutely. I mean, last quarter, they raised their guidance by almost $4 billion for this quarter. So when you blow out the numbers like this, expectations do go high, and the stock is obviously trading at, 25 times sales. So you have to ask yourself, even if they raise guidance this time around, can they raise it by 40, 50% the way they did it last time? And if they don't do it, that's when you could see a negative reaction.
There's a question also around whether the halo of this godliness of AI, which seems to have permeated through the entire tech sphere in the U.S. equity markets, whether that's going to sort of percolate out to the ARM IPO. I woke up this morning, I was reading about it, and I was reading about it last week, and I didn't totally understand whether it was just sort of this offshoot, not important. On a broader scale, though, it really signifies how much demand there is for the hopes and dreams of AI. What are you looking for as we get a greater sense that could really bleed into the sentiment around NVIDIA?
I mean, look, when it comes to generative AI, we know workloads were moving to public cloud before. Now everyone is saying, what is my non-discretionary spend when it comes to building the data centers? It used to be cloud. Now I think it's more and more AI. Every board discussion is about, do we have exposure to generative AI? And even though the ROI isn't established yet, but every company right now wants to invest in AI, and it will remain the case for the next 12 months.
I did sophisticated research on this. I went to the NVIDIA website. I clicked on the word cloud. I'm going deep into this, man, deep right now. Unleash the power of accelerated computing in the cloud. Is NVIDIA Microsoft's friend or foe? Are they Alphabet's friend or foe? Are they Elon Musk's friend or foe?
So the answer will differ. I think when it comes to Microsoft, Microsoft right now wants to be friends with everyone. That has been the approach that has worked really well for them over the last 5 years. I think when it comes to Amazon and Google, they have their own chip strategy. They want to sell more of their own chips when it comes to especially generative AI. And so it will vary. Tesla, I would say, Tesla has their own GPUs. They started off with NVIDIA. Then they gradually pivoted to their own chips inside the car. So clearly, hyperscalers are a threat to NVIDIA. But what NVIDIA has done well is they are always ahead.
What in God's name is a hyperscaler?
Well, hyperscalers are companies that have got huge data center footprint, and they are renting that data center capacity to all the small and mid-sized and even large businesses whose core competency is not to, deploy their own data centers.
Mandeep, I remember a company called ARM Holdings, used to be listed in London, wonderful management team led by Simon Segars. Is that coming back to market now then? And at what price?
Yes, we are expecting their F1 to be filed today, and then they'll do a roadshow. And from what we have learned, they will probably price the IPO at $70 billion. They're looking to have like 10% float here. And look, the revenue, trailing 12-month revenue was around 2.5 to 3 billion. So clearly the valuation is rich in this case for a new IPO, and we haven't tested the IPO market lately. And it'll be interesting
to
see.
What did SoftBank pay for that back in the day?
They paid $32 billion. And remember, NVIDIA tried to buy that company at $40 billion. That deal got terminated because of antitrust concerns. So that's your floor. But $70 billion is still a stretch.
I think so many of us forgot the history of all of this over the last several years. Mandeep, it's good to see you. Mandeep Singh there of Bloomberg Intelligence going into NVIDIA earnings. When are they? Wednesday. Wednesday. NVIDIA earnings coming up on Wednesday. Julian Emmanuel is going to catch up with us on that. Two big events for this equity market. Chairman Powell on Friday. And then, of course, the earnings from NVIDIA, Tom, on Wednesday after a gain of close to 200%. Yes, close to 200% year to date on that stock.
It's got to be important just because of that, but also after what we've seen from the others and the drawdown, if you will, in Microsoft and Apple, it's going to be a reaffirmation of how tech is doing getting out to the end of the next quarter.
Bit of a bounce this morning on the S&P 500, up by 0.4%. The band is back together. TK's back in a hot seat. It's always a good thing, Tom.
It's good. You know, Bayern was great. I thought Bremen was beautiful.
You've been watching the football?
No, I went. Bremen was great.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
In the middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are, launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV, for sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
This entire economic cycle has felt like it's been on fast forward.
All this talk about a recession so far hasn't panned out.
This current correction is not about growth fears.
What I see is a pull forward of consumption.
We are expecting that both Fed and ECB will stay on hold next month.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Getting deeper into summer, rounding things out. TK can't wait for Labor Day. That's why he's back in the seat. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance. What's that about, TK? Wishing away summer in America. What's that all about? What's that about? Just sort of wishing it away.
Here's the difference, okay? You guys are always on holiday. People that live on the continent, like Francine Lacroix, what they're doing, and Maria Tadeo, they're planning their next holiday where they're on holiday. All we do in America is work.
Let me speak for you guys. If we had the weather that you guys had here, which is phenomenal, then I would stretch summer right the way through September.
What is this, you guys?
Deep
What is
into
this generalization?
October. This is just a bit of banter, Bremo.
I like vacation. I grew up in America.
I think we're both on the same page here.
Sorry,
we
carry
both
on.
like vacation. It's TK that doesn't seem to like vacation, but it's good to have Tom back with us. Your equity market on the S&P shaping up as follows. Equity futures right now positive by 0.4%. Yields are a little bit higher, but that's been the theme, Tom, on a 10-year. Back to 430 over the last week.
That's a huge debate. We're going to have Julian Emanuel with us, dovetailing in with Ed Hyman's economics here in a moment. And it's just a raging debate. Now what? That we're back at these levels. And what's important here is the breakthrough price. For example, I looked at Lisa's Bloomberg Total Return Bond Fund. And if you take the trend from 2007 Jackson Hole out to 2021 Jackson Hole, we are 5 standard deviations down in price. I don't think people realize how off trend we are when we go out and visit Friday, and that's in the market here on a Monday morning.
It sets up the tension for Friday, Tom. This tug of war right now, some real tension between the progress we've made on inflation and the fact that growth is still running above trend, and the risk that this Fed declares victory too early and inflation starts to accelerate again, and that's what they want to avoid. Big time going into year end and into next year.
I totally take that point, and I've taken it for years. It's not just the Japanese, I'm going to call it 15, 20 years ago. It's other times in central bank history where you go, we're going to raise rates and then, or lower rates, whatever, and you go, oops, we made the wrong decision. That sits in the mind of everyone reading those papers.
We've already had one big oops, Elisa, from Chairman Powell in the last couple of years. He doesn't want another one.
No, and that's the question. Is he going to really look back at transitory and say, okay, mea culpa, we got this one wrong, and we are entering a new normal with some structural shifts that are happening right now? Unclear that he really wants to do that. Let the data come in to get some breathing space.
You
Mohammed
sound like
earlier
me.
is talking about, okay, just talk about some esoteric economic point that matters to no one and really come out with some conviction on it. And then, you know, you've said something, you've done your job, check that box, and you've done nothing to really harm anything or really change anything on the Fed.
Let's just be clear on this. Mike McKee, I don't know where Mike is. He's like, I don't know.
He's in the building, I think.
He's in the building?
I saw him walk in.
The papers at Jackson Hole are really important. And at 7:03 a.m. on Monday, John, we don't know what they are. They keep them hermetically sealed. And the answer is, who wrote the papers? Usually it's young bucks coming up the food chain. And of the papers, everybody will have their favorite paper. I agree with you in the last hour that what I'm really going to focus on is R-starred study. The whole R-starred debate is the paper I want to read about. Maybe I'll be wrong. Maybe there'll be something else.
That neutral rate, which we'll discuss through the week. Quick snapshot of the market for you. As I said, equities are higher this morning. Treasuries lower again. Yields advancing by 4 basis points. Lisa, just short of 430 here at 429.62.
The week begins possibly tomorrow, where we get the BRICS group meeting over in South Africa in Johannesburg. That's Brazil, Russia, India, China, and South Africa. Key question will be how much China brings India in particular to their side when it comes to creating some sort of economic and strategic rival to the G7. Wednesday, NVIDIA earnings after the bell. Republican primary debate in Milwaukee also taking place. Key question around whether anyone will be watching or whether they'll be watching some counter programming done on a platform yet to be named. And on Friday, all eyes are on Jackson Hole and what we hear from Fed Chair Jay Powell. He will be speaking at 10 a.m. Eastern. We'll also hear from Christine Lagarde. Is there going to be some sort of cohesion on what the new normal globally is, or are you going to start to hear a difference between these two policymakers in terms of their hawkishness or not as they head into a very different fall?
But my history here, help me here. I don't think they're going to talk monetary theory in their speeches. They're going to go wide. I mean, the courtesy of Jackson Hole is not to talk about what are we going to do at the September meeting.
That's your sense of things.
Yeah.
I'd say the one thing they're on the same page about is they've got no idea what they do beyond next month.
Exactly. They're data dependent as anyone. And Lagarde has to deal with Germany flat on her back and a few other items as well.
Great guest in the studio with us, Julian Emanuel of Evercore. Julian, good to see you. Good morning, mate.
Good morning.
Let's start here. This week, NVIDIA. Then we've got Chairman Powell. Throw in China into the mix as well. If you're coming back from the beach, dazed and confused, and you had to pick one right now, what should you be focused on?
Sorry, there is no pick one here. All of them matter. And to us, that is a large part of why we've seen the market drift gently lower, people taking risk off. This is not an end of bull market run. This is just a correction, normal, seasonal. Again, I would say what's really important is less what we're going to hear from NVIDIA, less what we're going to hear from Chair Powell, less what we hear. And overnight, we obviously had some moves from China, and more the price action in response to all of these things. And frankly, it's an open question as to what we're going to see in terms of the price action.
What everybody wants to know is to dovetail Julian Emmanuel's equity work in with Ed Hyman's economics. Ed has been out front believing in the disinflationary trend. Does he still have that in place, and how do you dovetail that into an equity call?
Absolutely. Absolutely. Ed, continues to think that inflation is going to come down much more rapidly than people believe. And, of course, part of that is we're likely to have a very mild downturn early next year. But when you pull back and you think about the implications for investing, there are actually 3 lessons from the 90s that we need to learn here. Number one, we understand the run-up into technology with AI, et cetera, et cetera. We think that's real. But the other thing there is that there is a time, such as we saw in the 90s, where markets do pull back. But the more important thing, because we've been talking about yields already this morning, is that you were able to make money in stocks in the 90s when yields were 5 and 6%. And the same thing is going to happen in the next 24 months.
Yeah, that's what we were talking about with Ed Yardeni last week, which is we've seen this movie before and it's fine. When we talk about China, is there any silver lining in the disinflation that we see over there, kind of creating more disinflation in the U.S., in Europe, or do you not buy that, what some people are putting out there?
Well, Chair Powell would love to be able to think that. I don't think he's going to discuss that on Friday. It's very marginal. If you look back at the episodes where China weakened incrementally, they had a volatility-inducing effect in the U.S., very temporary. As we know, the U.S. is very much its own engine.
We've seen some divergence. Do you sense that divergence can continue between what's developing here in the United States and what's developing in China?
So that there is a point to which it cannot, okay, which is why, again, what's so important is exactly, are we going to have a whatever it takes moment in China, or conversely, if we have what the market perceives to be a whatever it takes moment, is it going to be that famed Greenspan phrase, pushing on a string? It's an open question.
I look at the equity market. I want to go back to what Yardeni, Lisa brought up the brilliant interview they did with Yardeni last week, and what Ed feels and what we all lived in 94. 94 had almost a malaise in it. And then boom, 95 moonshot. Can you call here a second leg of a bull market at some point out there, given the emotion, the malaise we're in right now?
We think it lies ahead. We think you have to go through, and again, this is another lesson of the 90s, right? Is that the technological revolution that we think we're undergoing right now with generative AI, it didn't negate the idea of a recession. It postponed it, and I think that's part of the narrative. We are going to have a recession at some point. Business cycles are not canceled from things like this.
So where are you looking to really see the ramifications of a new higher rate world? You were talking about how we've seen 5% yields before and stocks keep rallying, but some areas fell out of bed. Are you looking for there to be similar carnage in small pockets that cannot survive at rates that are as high as they are after growing up during an era of zero rates?
Well, profitless tech that's going to have to refinance over the next several years will certainly be under stress. But think about it, in an environment where rates are high, inflation is still high, and economic growth. I mean, GDP now is pushing 6% this quarter. That's an unfathomable number. That's where value, largely forgotten, energy and healthcare looks interesting to us. And if you're a hedger, the fact that interest rates are over 5% is very, very good math for options hedging strategies.
Ed Hyman has no clients who are under 70 years old. We all know that. But for the Ute of Evercore ISI like yourself, how do you and Hyman and the rest, how do you explain to people that have never enjoyed high interest rates, a legitimate a real yield, a legitimate risk-free rate? How do you explain to them that we didn't all die and roll over in the 90s?
So what's fascinating about it is, if you remember, for much of the post-financial crisis world, there was an angst every time the market started rallying, and there was a feeling like it was going to run away. Why? Because you couldn't make anything on your cash, okay? This time, people are like, okay, I'm good. I'm still getting 5% on my cash, which actually, if you think about it, is the thing that feeds the longevity, multi-year longevity of a bull market.
The demo goes beyond the 70-plus demo, doesn't it? For research over at Evercore. Julian, what's he talking about? What's he talking about?
I'll tell you what, given the work that we've done on generative AI, to have the 20s and the 30s people and interact, we've got it all covered.
You tell him, Julian. I want to understand this, Tom, why banks are down so hard with yields up and the curve steeper over the last month.
Well said.
If it's good stuff, yields are up 33 basis points in August. You want the banks on the S&P 500, they're down 8%.
You know what I'm looking at?
Through August.
Well, I read Crane's every day, and a great website, Real Estate with Bloomberg, and I'm sorry, I'm watching what the adults are doing, and that's Vornado. And the answers, you talk about the banks, these seasoned CRE people are acting. They're not in, there's no task forces. It's like, what do we need to do this week to unload property X or buy property Y or get the Japanese to buy a building in Lower Midtown? Whatever, that's what I'm watching.
Given the way things are going, they can't afford a task force right now, Tom. If you're just tuning in, welcome to the program. S&P 500 futures here positive by 0.4%. Yields are higher by 4 basis points on a 10-year, 429. Julian, just quickly, what's that about? The move we've seen in yields and the bank's not rallying, the bank's actually selling off.
I think there's still this thought, again, and that's Ed in our base case, that you're going to have a recession out there somewhere in 2024. And look, as much as we want to think the Fed completely backstopped the banking system in March, there's still the potential
Those worries
for
still linger.
Financial volatility.
You get a sense of that, Tom? Those worries still linger from spring? Haven't quite cleared the decks and moved on?
I'm in that camp. I am in that camp because of CRE. Everybody's telling me it's just office buildings. Everything else is fine. I'm watching the action of these people. And again, there's no task force. They're like, let's go.
There's also an issue with the fact that people don't want loans, right? They're not necessarily taking out loans, so they can't capture those higher yields because no one wants to pay them, number one. Deals aren't getting done, number two, because yields are too high. You're seeing a lot of that sort of investment banking activity fall off. These are major sources of revenue that have stagnated. Talk about the mortgage market and all those mortgage brokers. You know, think a thought for them who are not really doing so hot this year.
And off of arm in London, which I really don't understand. But John, over the weekend, there's this percolation. IPOs, they're going to come back. Says who? I mean, ARM, whatever, AIM, ARM. ARM, yeah, whatever. Software, SoftBank.
7:30 Eastern Time. 15 minutes away, 16, 17 minutes away. Amanda Lynham of BlackRock. We'll have a conversation about fixed income and credit and the refinancing that never was, the maturity wall on the horizon, and how painful it might be. All of that good stuff on a Monday morning. Live from New York City. Equities are up. This is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The
heard the market analysis.
We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
This week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
Do you think that Donald Trump should drop out of the race?
I think so, but obviously that's up to him. I mean, you're just asking me my opinion, but he will lose to Joe Biden if you look at the current polls. I'm a Republican. I think any Republican on that stage in Milwaukee will do a better job than Joe Biden, and so I want one of them to win.
That was a word from Senator Bill Cassidy of Louisiana speaking on CNN over the weekend, live from New York City this morning as we kick off a brand new trading week. Your equity market with a little bit of a lift. 4 days and no gains on the S&P 500 coming into Monday this morning, up by 0.4%. Yields are higher by 4 basis points on a 10-year, 429.42. Just publishing moments ago, Max Kettner of HSBC. We'd used renewed sell-offs in equities to scale up exposure even further. The take from buy? Max Kettner, I believe that means buy.
Scale up exposure.
When you get paid lots of money, Tom, you have to find new ways of saying buy. Okay? You know how this works.
Okay, so if you're going down Madison Avenue and you walk in any given luxury store, you scale up exposure?
Maybe. Maybe that's if you paid lots, Tom. If you paid lots. Looking elsewhere, TK, looking ahead to Chairman Powell, of course, on Friday. NVIDIA earnings coming up on Wednesday. Lots of worries, no doubt, about China. Somewhere in between.
Senator Cassidy there, Louisiana, he's in our Hall of Fame. He's a doctor. He's like the real deal.
Didn't he tell you to lose some weight?
So we're sitting here, and he's sitting here right now.
I was here.
Oh, man. We're live on here. He goes, lose some weight.
Lose some weight. Did he know the microphone was hot?
No, you know, it's like, you know.
He speaks his mind.
Yeah, he speaks
I think we heard him speak his mind about the former president just then as well.
There's a lot of that going on here. We've reviewed this morning the CBS poll by Donald Trump. John, I want you to bring in Amory Horton because you guys are way up to speed on this versus me. But this is not another poll. This is Anthony Salvanto over there with Margaret Brennan and Face the Nation. And the depth of that poll is extraordinary.
MH, let's start from the top, and good to catch up with you this morning, as always. Walk us through just how dominant that lead now is for the former president.
Well, it's the widest lead we've seen yet in any of these polls when it comes to the former president and his hold on the Republican Party. This obviously comes ahead of a really crucial week for the GOP and the candidates as they face off in Milwaukee for a debate, although the former president does not plan to attend. He'll do his own sort of counter-programming, although we should note his VP, Mike Pence, former VP, said over the weekend on ABC that he knows the former president very well, and you just don't quite know until the very end. So there is this little bit of potential that he would show up. But at the moment, it doesn't look like he'll be showing up on that stage. And if you're the former president, you have to think, why should I? I am dominating in these polls. And his lead even widens so much against the second candidate, and that is Governor DeSantis, who's now at 16%. So his numbers are falling, and then everyone else is in single digits. So you have this hold on him. But I would also bring you another poll this morning from NBC News and the Des Moines Register. And what that is showing is that there still is a little bit of wiggle room for others to potentially shine. It is still early on in this race. But of course, the former president is an incumbent, so it's different than any other candidate we've ever seen.
There was a lot of fanfare around Tim Scott over the weekend as people try to game out who number 2 will be, with Ron DeSantis pretty much losing a lot of his sheen, a lot of questions around his campaign. Is the energy really coalescing around Tim Scott? Is there discussion about new entrants into the race? What's kind of the feeling in D.C.?
So two things. When you look at Tim Scott, and I would again point to this NBC poll out this morning, when you see the favorability of this individual versus disfavorability, he has really good numbers. He has very high numbers on favorability and low numbers on individuals who don't think favorably of him. So he has this potential, and people want to hear more about him, but in the first glance, they seem to like him. I would go more so about what's being spoken about are the individuals that are currently not in the race. And I'm going to give you two governors, Governor Youngkin of Virginia and Governor Brian Kemp of Georgia. Both of these individuals closed out on Saturday this conservative gathering in Atlanta, and the conservative talk radio host who was talking about it said I was going to make a joke that this is the Republican ticket, but I'm not. They're not running. But the fact of the matter is Brian Kemp is becoming somewhat of a kingmaker, and this is someone who has stood up against the former president when it comes to Georgia's integrity and the election. And then obviously Glenn Youngkin, a lot of donors, a lot of Republicans are in his ear. They want him to get into the race, and the most important one, Rupert Murdoch, according to Washington Post reporting last week.
And Lisa, Anne-Marie, one final poll that's just out. This poll is just in, and it states that the Yankees are in last place. I noticed 1-9 with the Red Sox sweep as well. We need to bring that poll to you right now. Folks, let's move over to the other side. What's the Biden plan? I get it, he's incumbent. He's doing Camp David summits. Wonderful. What's the plan?
Well, Biden today will be visiting Hawaii and seeing the devastation of these wildfires. It comes at a critical moment for him. This is one of his biggest domestic policy issues, or I should say controversies, because he was silent for a number of days publicly. And when he was asked about it when he was vacationing in Delaware on the beach, he said no comment. And many people view Biden, right and the left, as this compassionate leader, even if they don't agree with his policies. So he has a moment today to potentially bring that warmth and empathy to a place that's the images and the death toll, especially amongst children, is horrific. But he will be in the spotlight in terms of the fact that there was this controversy because he remained silent for what many would say was too long.
Right. Does he have a plan in Ohio? Does he have a plan in Arizona or Georgia to get the turnout that got him elected if Mr. Trump had more votes last time than the time before?
Well, this is a great question because what you've seen in past presidential races like Obama the second time around is that you do start to see independents and their votes dwindle in some of the major cities in these swing states. What the Biden administration is doing right now, which feels like campaign events, is that they're going around the country in some of these states. He was just in Wisconsin. He just sent his Treasury Secretary to Nevada. They have been in Arizona. And they are talking about the wins they've had under his last 2 years, and they are trying to sell that those wins are going to be good for the economy because it still is top issue for American voters. It's pocketbook issues like the economy, like inflation that they want to hear candidates talk about. So that seems to be their plan so far. Obviously, this will all ramp up next year.
We talk about the key issue of the economy. Both sides have the same kind of general issue that they're concerned about. But when you dig into the granularity, it's completely polar opposites in terms of the perception of the economy. What is the economic issue that there is any cohesion on both sides? Or just simply bringing inflation lower? Is there any cohesion around the Fed? Is there something that really kind of is a driving force in the election?
Well, on one side, on the Democratic side, you really just have Biden, right? He is going to be the nominee, and he is the current president. On the Republican side, there is some divisions. They're all going to bash the Biden administration, and they have been, when they talk about the economy, and their number one issue has been inflation. And they even say to the Biden administration, yes, inflation is coming down. It's slowing at a slower pace, but still, Americans are paying much more for groceries, for food, for rent than they were before Biden came in. So that is their argument. When it comes to the Fed, we've seen very different views. There are some individuals, like the former president, who want to get rid of Jay Powell if he was elected. Also, VP Mike Pence. There's others who just don't want to pinpoint specific appointments and policy decisions just yet. And then you have others like Governor Chris Christie, who said he didn't think Jay Powell, yes, he was late, but didn't think he's done anything horribly wrong. So these issues are going to be front and center on Wednesday, especially if the former president is not there. It is a potential for all these candidates to talk about their main policy objectives.
It's the cheat guide on the economy, Tom, going into Wednesday. Bidenomics bad, Chairman Powell, no thank you, and bash China. They seem to be the 3 points.
I think that's good.
It's
maybe,
Wednesday.
Yeah, I totally agree. And maybe bash China, you put that first because it's a bipartisan effort. You can get people right up. To me, and this is getting way out front, way over my skis here, it's about turnout. And I can't say it enough.
Isn't it always?
It's always about turnout. And you got to talk about turnout in November next year now.
That's the cheat guide to political punditry, isn't it?
Yeah, it is.
It's about turnout. AMH, thank you.
I'm looking
down
at
in Washington, D.C.
I'm not concentrating. I'm looking at Zandvoort. Do you know there's Formula One racing this weekend?
Didn't know that. Is it back?
Yes.
Very cool. Very cool.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Four days, no gains on the S&P 500. Looking to change that this Monday morning. Good morning to you all. The price action shaping up as follows. Up 0.5% on the S&P. On the Nasdaq, up by 0.6%. The 10 of the month, brutal. The Nasdaq 100 down on the month by close to 7% so far this month. If we closed here, Tom, shut it all down for the month of August, worst month of the year.
worst month of the year. It's a pullback. I mean, there was a lot of good work this weekend on correction, not bear market. A correction is 10%. I do it by standard deviation, which is some fancy math nobody cares about. And the answer is we're supposed to do this. This is normal. You don't go up every week with your Apple or whatever.
But you know what happens every time it does happen? Is it something more sinister? Is it worse? Could it go further?
Is it a toxic brew?
Is it the end of it all?
It could be a toxic brew.
Could this move in the bond market continue? Let's turn to treasuries, 2-year, 10-year, 30-year, 10-year. The yield climbing for 4 consecutive months. Over this month alone, we're higher by about 30 basis points this morning. Up another 4, Tom. Let's call it 430 for those of you that like it a little bit more specific. 429.82.
So if you have
on
a chart
this morning,
and you have a curve to the chart, and you take the y-axis and you go logarithmic, that's all I'm going to say about the math. If it's still curvy after you've gone logarithmic, that's called log convex. Everything, including renminbi, the 10-year real U.S. real yield, the German paper, everything right now is log convex.
Yields up and away, Lisa, on a 10-year, on a 30-year as well, this morning as well.
It's significant because we're reaching levels that we haven't seen in almost 2 decades. It's also significant we haven't seen a bigger pullback in equities, in credit. To Tom's point, that's notable. We normally would have gotten some sort of big retracement. Suddenly the market is interest rate sensitive. Not anymore. And so now people, like what we heard from Julian Emanuel, gaming out. Okay, what if they stay here? So what? We've done this before. Welcome to normal.
Credit hasn't done much at all. We'll talk about maybe some refinancing activity later into next year, changing some of these prices. We'll talk about that in a moment. Let's finish on foreign exchange. In the FX market, the euro just in and around 109 through much of this morning. 109.11 right now, positive by 1/3 of 1%. The euro showing a bit of strength. Under surveillance this morning, the bond bulls doubling down in the face of subpar returns and a deepening sell-off. Bob Michael of JP Morgan Asset Management, among the bulls that are still bullish on this bond market, saying his strategy is to now buy every dip in bond prices. And Tom, there's been plenty of dips in bond prices over the last couple of weeks.
I mentioned it earlier, I just taken all the summed in. This is the Lehman Index, the Barclays Index, now the Bloomberg Index. There's 5 or 6 of them, and the answer is I just look at the total return, the bond market all in, and boy, has it been price down, yield up, and we're way off the trend, that comfort trend that Bill Gross talked about for years. 5 big standard deviation move.
I think it was Gagi over at BlackRock that said yields of dreams. Yields of dreams. Tom, 2 years ago, these were the yields of dreams.
If you clip
They're here now.
They will come.
Something like that. That's good. That's good, Tom.
Did I do okay there?
That was actually brilliant.
Like, I'm medicated. What can I say?
If you'd said this 2 years ago,
where's the tang?
That we'd be here, TK, no one would have believed you.
No one.
No one would have believed
you.
This
goes into Jackson Hole. Okay, let's dovetail Bill
and now
Gross,
they're here,
Muhammad
and
Larry,
people are sitting here saying, "Oh yeah,
this is
like this."
This is the great moderation that built BlackRock, and it was a stability, and it was forever yield lower, price up. Wind, behind you. It's a sailboat analogy, I think. You should see me on a sailboat.
This is going well, Tom.
This is going well. But the answer here is the great moderation is over. And that's the backdrop for Jackson Hole.
You've had a lot of time to think, haven't you, in the last week?
Way too much time.
Chinese equities, let's talk about those. Extending losses. The Hang Seng seeing its longest losing streak since 2021. The Hang Seng in a bear market. Mainland banks surprising by keeping a key interest rate tied to mortgages on hold. Lisa, where is that stimulus that so many people are waiting for?
They keep underwhelming, even though they see the reaction as being negative in risk assets, raising the question, unwilling or unable. Is that really the question for a lot of the Chinese policymakers at a time where we heard Bill Lee say they're pushing on a string? We're looking at a situation where they can't stimulate without causing pain to the financial system and just further the contagion.
Who we miss right now is Elizabeth Economy, her iconic book, The River Runs Black. She can't talk because she's working for Gina Raimondo at the Department of Commerce. But Dr. Economy and others, and again, I go to the Adam Posen article, Ian Johnson, also in the new edition of Foreign Affairs, definitive reading on the complexities that the dictatorship in Beijing faces.
And Liz warned about some of these issues for a
Huge,
long
way
time.
out front, way out
That's
front.
a voice that's missed.
Yeah, it's missed, big time.
Great she's in the administration, Tom, to your point. I wanted to finish on this because we have a great guest around the table, but this is important. California, of course, bracing for flooding from Tropical Storm Hillary. The National Hurricane Center warning of, quote, life-threatening and catastrophic flooding. The storm also amounting to over 550 flights cancelled just today and tons more over the weekend. Tom, we're talking about a year's worth of rain in parts of California. Just unreal figures.
Not Florida, but not funny as well. And it does go into the aberrations of the moment. I would note, I don't have it in front of me, but 3 tropical storms building in the Atlantic, which is highly unusual. There's only been 2 times since 18 whatever, since Bogart was in that place in Florida with Lauren Bacall. But the answer is, it's an unusual season to begin with, and how unusual this rain on a desert parched floor is.
Well said. And Tom, just to wrap it up, yeah, absolutely. I think our thoughts with everyone on the West Coast this morning, TK. We hope they all stay safe.
I talked to the middle child is out there, and she's on strike lines. And,
she's striking.
She's striking, yeah. She's out picking, and I don't know what for.
She's learning your communist ways early.
She's good. She's got a degree. She's got a degree. Yeah, exactly. She never watches. It's too early in the morning for her. Always watching is Amanda Lynham, who was brilliant the last time she was on. She's had a macro credit research. This is without question our fixed income interview of the day. Amanda, thank you so much. I want to go to the nitty-gritty of what you do. You have debt that is fixed coupon dynamics, floating, like John's really familiar with in Europe and England, which is where the yield floats around given the movement. And then you've got CRE, commercial real estate, and all the debacle there. How unstable or potentially unstable is the fixed income world right now?
Good morning. Thank you all for having me. I think they're all impacted by this higher cost of capital environment that we're expecting. And Lisa, you alluded at the start of the program, is this the new normal? And I think the key difference between what you highlighted, Tom, is that for the fixed income, fixed rate part of the market, they're getting impacted on a different timeline than the floating rate part of the market. And in that floating rate part of the market, specifically the broadly syndicated leveraged loan market, you are seeing an uptick in defaults. And this is something that's been happening for the past few months, but the magnitude of the pace of leveraged loan defaults outpacing the fixed rate high yield bond space has been notable. It's the widest margin since the Moody's data began in 1996. We see scope for that to continue, even though it is unusual, and that's because we are expecting this higher for longer cost of capital environment. The other 2 things I would point to is that the fixed rate investment grade universe is much better positioned to manage through that higher cost of capital environment because they just have more optionality in terms of refinancing. So we don't always rely on ratings as a barometer for performance, but I think in this instance, being investment grade, having the ability to replace maturities at a later date instead of refinance them is going to be helpful. And then on the point on CRE, Tom, I think really nothing in the news flow over the past few weeks has changed our view that we're in the early stages of the distress cycle in CRE. And I think, in fact, the news flow recently has reinforced that view. And it's a combination of refinancing.
That was uplifting. Save us, John.
High yield spread still super tight into the tights of the year. And this is happening even with a higher for longer conversation around the Federal Reserve. You know where that maturity wall is. So walk us through it. Why are spreads this tight when we face the risk of that maturity wall kicking in later next year?
Right. So 2 things. One, as it relates to the timing of the refinancing. The maturity wall we know begins in 2025. High yield corporates will want to address that 12 months or more beforehand so that the debt doesn't become current. That has implications for the audit. So we still have some time. And as we've noted, high yield corporates in particular have the luxury of being patient because they've been so proactive about liquidity raising in 2020 and 2021. And it was not unusual during that kind of period right after COVID, the onset of it, where corporates were pre-funding 3-4 years in advance. So we've got some time. The second point that I would note on the spreads, and this is a conversation we've been having more with clients, there's this relative value tug of war happening in the credit market where spreads in isolation are quite tight. But for yield-based buyers, the elevated risk-free rate, which has intensified most recently, as you've all been discussing, is giving them some cushion to deploy capital at still relatively attractive all-in yields from a historical perspective. And so, ironically, even though spreads are quite snug, the overall value that's provided by corporate credit, because it's boosted by the risk-free rate, has insulated that to some degree.
How transformed is high yield as an asset asset class because in some ways it's the new investment grade and private credit is the new high yield. We're looking at an entire spectrum of lending below the covers that's taking over and buffering some of the financial pain that we would otherwise might be seeing in some of the high yield names.
That's right. So the high yield universe in particular has had much more overlap in recent years with the investment grade landscape because there's been this fallen angel rising star dynamic that has really intensified. So you've seen names move, I think, a little more seamlessly than we would have guessed in 2018 and 2019 between the two markets. And the high yield market has shown its ability to absorb those capital structures. There have also been some really meaningful shifts in sector composition. The high yield market serving a larger and larger borrower. Changes in maturity and duration and sector skews. Energy is not as problematic in this cycle as it has been in the past. Those are all probably contributing to this tight spread environment in high yield. In private credit, we have a very favorable view of it as an asset class, specifically in an environment like this where you can introduce some granularity and some selectivity to deploying. But to your point, the $1.5 trillion asset class is a relatively post-financial crisis phenomenon. And so it makes things like we've looked at in prior cycles, like the senior loan officer survey, perhaps less directionally correlated into the broader state of the market because you now have this asset class that's allowing corporates to diversify their funding away from the banking channel that wasn't in place to as much of a degree pre-financial crisis. And so when you think about bank lending contraction and that automatically leading to a recession, that may not be the case as much directly this time around because you've got this other source of funding. But as it relates to private credit, I think if you're in an environment where you really need to be granular about companies' ability to absorb higher costs, manage through a higher cost of capital environment, you want to be more selective and granular. And I think parts of private credit, specifically senior direct lending, allow you to do that in a higher cost of capital environment.
A clinic, as always, Amanda, just wonderful. If you are just tuning in, welcome to the program. The S&P 500 right now positive by 0.5%. A little bit later in the program, we'll catch up with Claudia Sahm of Sahm Consulting and former Fed economist going into Jackson Hole and that annual Fed get-together later this week. Can we squeeze one in, Amanda? Just bonus round. Favorite sector right now? Have you got one?
Well, I think over time, the financial sector does look attractive. You were talking about the underperformance recently. I think in addition to some of the cyclical concerns, it might also be regulation and potential refinancing needs coming from the sector. I think once that settles down, that will be a pretty attractive place to look.
The bank's in focus, TK. Going into Chairman Powell on Friday.
Oh, a big focus. They're going into Chairman Powell, but I think it's a lot more than that. It's earnings season and the rest and how they adapt and adjust to interest rates, as Julian Emanuel was talking about, back to 90s. I mean, it's banks back to the 90s is maybe the headline.
Elisa made the point in the last hour, and I think it's a really important one. Yes, yields are higher, and technically we talk about that correlating with better bank performance in the equity market. It hasn't at all in the last month. Demand for loans. Demand for loans is a massive feature of all of this, Lisa, not just here stateside, but also I'd make the same argument for China at the moment. We've seen demand for loans there just, rock bottom. It's not there.
They don't want to borrow at the rates that are the going rates. But to Amanda's point, the degree that they do borrow, they're going to other channels outside of the banks, whether it's private credit, whether it's the public debt markets. And that's creating a real problem for the banks. Where are they going to get that extra yield that gives them that benefit when yields rise?
Amanda, thank you. We need to do this more often. Like on a weekly basis, a credit update. I'm not sure you or BlackRock want to do that. It's far too stressful waking up so early Monday in the morning to do some of this. Amanda Lynham of BlackRock there on fixed income. Live from New York City this morning. Good morning. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have